Now let's walk through exercise 6-9. This one's kind of interesting because we get to talk about the different characteristics of the different inventory methods. So these are just things to know about the different inventory methods. You can look the answers up in your book. The best way for you to approach this exercise is to try it on your own. So pause me and then come back and we'll walk through what the answers are. So the first one, generally associated with saving income taxes. The LIFO has the distinction of usually being known for saving income taxes because LIFO, your last in or your first out, so your most recent units are on your income statement as expense. Your most recent items are usually most expensive items in periods of inflation, so you have the highest expense on your income statement. So that's generally why you save income taxes, because you have more expense, less income. Okay, the next one, used to account for automobiles, jewelry, and art objects. That would be specific unit or specific identification method, because we can have serial numbers on cars, jewelry, not costume jewelry, but expensive jewelry and art objects are all unique and we can track them. The next item results in a cost of ending inventory that's close to the cost of replacing the inventory. That's going to be FIFO, because FIFO means that the first ones in are the first ones we sell. So the most recent units are the units we most recently bought, which means they're valued at the closest thing to replacement cost. Number 4, FIFO will maximize reported income because it has the lowest expense, because those are the oldest items on the income statement. Number 5, enables a company to buy high-cost inventory at year-end and decrease reported income, because last in, first out, whatever we buy most currently is what's on our income statement. Okay, number 6. Results in an old measure of the cost of ending inventory. That's LIFO, because your ending inventory is your oldest units. Number 7, provides a middle ground measurement of ending inventory cost of goods sold. That would have to be the weighted average method. Number 8, LIFO will enable a company to keep reported income from dropping lower by liquidating older layers of inventory. So that would be LIFO. Whenever you see liquidation of older layers, that always has to be LIFO. Writes inventory down when replacement cost drops below historical cost. That's every method. That lower of cost or market is always going to apply to all the methods. And then finally, matches the most current cost of goods sold expense against sales revenue. That's LIFO. Now, an interesting thing is, it's in your book, but LIFO is not acceptable under international financial reporting standards. So, and there is a movement in the United States. There are certain people or legislative bodies that want to see LIFO go away. If LIFO goes away, lots of companies will have big tax burdens immediately, so it's a revenue grab as well. So that's it on short exercise 6-9.